This video is going to give you a basic understanding of what is options. A lot of people talk about it, a lot of people trade it, but what are options? And in this video, I'm going to be explaining to you everything that you need to know about options, and we're going to start a presentation right now. So this is going to be a guide on what is options, and I'm going to be explaining all of the basics so you're able to understand what is options. We're going to go over literally everything a beginner should know about options, and let's get into it. So what are options? Options are a financial contract that give the buyers the right but not obligation to buy and sell an underlying asset at a determined price. So what do that basically mean? That means you're able to buy a contract, but you do not need to hold the actual asset. So a quick example of that is SPY have option contracts. I'm not buying SPY, but I am buying the option contracts that is going to move if SPY moves. So if it goes up or down, depending on if I buy calls or puts, that option contract is going to gain value. But I'm not buying SPY at all. So that is a good way that I understand it. And we're going to go into expiration dates. Now let's get into expiration dates. Expiration dates, every option have an expiration date. After this date, the contract expires worthless if not exercised. Time is literally money in option trading. So when I say time is literally money in option trading is when you buy SPY shares, right? You do not have a time where you have to sell it. You can literally sell SPY whenever you want to. But with an option contract, you're not going to get that privilege. Every option contract do not last forever. They're always going to have an expiration date. And within that expiration date is going to force you to sell, or if you're not selling, it's going to expire worthless. Why trade options? Leverage, hedging, income generation, and a strategic flexibility. Options allow traders to control a large portion with a smaller amount of capital while managing risk. I would say options is the only thing in the market where you can start to trade with a little bit amount of money and get bigger returns. For example, every option contract is worth 100 shares, and you can manage 100 shares for $100 or $50 and be able to get the gain. So when we talk about income generation is going to be really effective with options, just because you're able to manage more money with a little bit amount of money that you have liquid or within your broker account. Now we're going to talk about calls and puts. Calls is a bullish bet. It's the right to buy. You profit when the stock price goes up. Above the strike price, you're betting the market will rise. It doesn't always gotta be above the strike price. Sometimes I buy contracts below the strike price, which we're gonna talk about more later in this video. And well, above the strike price, and I don't sell it. I just sell it because I know the price is gonna go up in value. So you can buy a contract, right? And it can be worth $50, and then it can go up to $80. And that would be 20-30% gain. That'd be a 20-30% gain with just buying a call, even if it doesn't go above the strike price. So now with puts is the right to sell. It's a bearish bet. You profit when the price of the stock is going down. It doesn't really got to be below the strike price. Whenever the asset starts to fall down, that is when you're going to make money with puts. So just look at it like this. Calls is where you're betting that the market is going to go up. Puts is betting that the market is going to go down. What I do like about options is that you literally can make money from both sides. So a lot of people be asking like, oh, if you trade, what is going to happen if we go in a recession? That means put options are going to be more expensive because more people are going to be able to profit off of those put options. So keep that in mind, because calls are always going to be buying and puts is always going to be selling, and you can make money both ways. What is a strike price? The predetermined price at which the option can be exercised. How does it work? The strike price is agreed upon a price for the transaction if the option is exercised. It locks in when you buy the option and never change. So basically, a better way to explain that is each, say with SPY, right? You got a 600 call, you got a 601 call, you got a 602 call, and below that you got a 599 call, a 598 call, and a 597 call. So basically, if you're buying a call, right, anything that is above the price of the actual share price, which is, let's say with this scenario, SPY is at 600, anything above 600 is going to be out of the money. Now, anything below 600 is going to be in the money because we're betting that the market is going to go up. So out the money is betting that we're hitting a price that we're not hitting at that specific moment. And in the money is betting that it's going to keep on going more up from the price that you bought the strike price at. That's the basic way to how I use strike prices. Majority of the time I buy out the money and try to sell within the money because you're going to get a bigger gain just because of the Greeks. But now we can talk about the Greeks and explain to you why the Greeks matter. So the Greeks in options trading, what I would say is the most important thing to know. If you do not understand the Greeks, you're going to have a really bad time with trading. You can have a really good strategy. If your strategy do not correlate with the Greeks, you're going to have just a more difficult time just trying to be profitable with trading options. So the Greeks is risk metrics that measure how the option price is going to change with market conditions. The Greeks is the reason why an option price can gain value and lose value. So first is delta. This is price sensitivity. Delta measures how much an option price is going to change for every $1 move in the underlying stock. Range to 0 to 1 for calls and 0 to -1 for puts. With your delta, typically it would be 0.43, 0.50, sometimes 0.70, depending on what asset and if you're buying in the money and out of the money cons. The delta is going to show you how much money the option contract is going to make off of a $1 move. If I have a 0.40 delta and the price of the asset goes up $1, that means that option contract is going to be able to go up $40 or 40 cents. Gamma is delta change. This measures the rate of a change in delta. Shows how fast your delta will move as the stock price changes. Highest win at the money. So that basically means the more gamma, it measures how fast delta is going to change. So typically with same day expiration contracts, you have high gamma. And high gamma is the speed of how the delta is going to be able to change. That's why with high gamma, if you get a strong candle, your contracts are going to just be worth way more than what it would typically be if it was to hit it for hit the same price but take more time. Data is basically time decay. Time decay measures how much value the option loses each day as expiration approaches. It's always negative for option buyers. Time is typically going to be your biggest enemy. So with option contracts, definitely same day expiration contracts, you're going to have a high data. That is the con of options. You're going to have time decay. The more it comes to the expiration of the contract, the more worthless it's going to become. So just for you holding a contract for more than a day or an hour is going to automatically be losing money just because of time decay. Now, lastly, Vega, volatility sensitivity. It measures how much the option price changes with a 1% change in implied volatility. Higher volatility equals higher option prices. So that basically means the more volume that is going into these option contracts, the more is going to be worth. So for example, a good way to explain it is typically on days that have high impactful news such as CPI or an interest rate decision, there's going to typically be more volatility. That means the Vega is going to make the option contracts cost more just because it's going to have way more volume within the day. So that is something that is very important to know as well. With the Greeks is typically, I would say, the most complicated subject to learn. But once you're able to understand this, which is I gave you a basic understanding of the Greeks, you're able to know if you're hitting a TP, if you're taking a trade and you win a trade but you're not winning as much money, you're having a Greeks problem. And definitely if you're losing money if you're hitting the TP, that means your data may be too high. That means you're gonna have to buy more in the money contracts. Or if you're trying to maximize gains and if you have a strategy that moves really fast, that moves with volume, you can buy more out of the money contracts because now you have Vega, Gamma, and Delta working with you because you're going to be in contracts in a small period of time. So knowing how your strategy works in performing in different type of markets, you're going to also need to understand the Greek so you're able to know what is working for you and what is not working for you, and what is not working for you, you'll be able to change. So this is a basic explanation on how options work. And if you want me to make a video on how to buy options or any other videos, make sure you let me know in the comments and I will put it on my list of videos to make and you will have a video. So it's pretty good. So ask while this is still a new channel because it will be really, really hard to do that more in the future. So I see you guys next time. If you like the video, make sure you like and subscribe. And peace out.